Hey traders, Todd here of tradinganalysis.com. This is the free video for Thursday, September 4th, and we're going to follow up on the trade idea we gave you guys yesterday, which was the IWM, the Russell trade. So we have been long the Russell, as we've spoken about a bunch of times in the free videos here. If you've been following along on our YouTube channel, we exited those trades yesterday, and we're actually looking to flip and go short based on this pattern. So let's dive in. This is the Russell 2000 cash index in the white open, high, low, close bars. And what I've done over here on the, over there on the left side is overlay the IWM, the Russell ETF, so we can get some equivalent prices because that's what we're going to be trading. So we got IWM on the left, Russell on the right. Okay, so here's the pattern we've been trading. This is a fourth wave Elliott triangle. Okay, it's a 5-leg pattern labeled with letters A, B, C, D, and looks like we've been long for the D wave. We've exited. Now we're looking to go short for the E wave decline. Now, thing about Elliott triangles is you can project how long each of the waves is going to last by comparing it to the wave not before it, but 2 waves ago. So what that means is if you want to project the top of the D wave, you look not at the C wave, but you look at the B, as in boy. So that's why I have this D versus B 618 relationship. A lot of times, because triangles are contracting, you'll get a 0.618 relationship compared to the wave at 2 positions ago. So that means in the E wave, we want to look 2 waves prior to the C, and that gives us a 618 projection at 1125. That's the downside target in the E wave. Now, going back up to the D wave, we have 2 other little fibs levels here. We have a 1272 external retracement, and we also have a 786 retracement of the C wave decline. So basically, we have 3 Fibonacci resistance levels to say, I don't think the Russell is going to get above 1190 in the next month and a half or so. So therefore, we're going to take this E wave decline down into the end of September. Now, we projected the price support for this E wave. We can also do a time projection, when it's going to happen, by looking at prior waves. 0.618 is ideal, and that's on September 24th. It could get out to the 100%, which is on October 7th, but somewhere in this price and time zone, the Russell should bounce. Okay, so we're not looking for an all-out decline. We're just looking for a multiple, say 3-week decline down to about 1120 towards the end of September, early October. Then the markets should find support and move up to new highs. So here's the option structure we're going to look to play. All right, this is a multi-leg structure, a little advanced, so strap in, put your seatbelts on. Here we go. Now, what I've done is, let's move to Thinkorswim. And I'm looking to do this in the October options, October monthlies, 44 days to go. This 17.74%, that is your standard deviation. That's the implied volatility. That's the +1, -1 standard deviation for the OCT monthly options. It's $5.77. So what you do is you take that and you multiply it by the current price. So right now, IWM 116.40, that's close enough. It closed at 46, that's fine. +-1 is at 577. So a +1/2 standard deviation is at 119. A 1 standard deviation is at 122. -1/2 is at 113. And a full -1 standard deviation is 110. Now, let's bring back up the chart and compare those standard deviation levels to the Elliott Wave levels. And this is where things get kind of badass. So, for the Octobers, let's look at the call side. We want to do an iron condor. Okay, I love doing iron condors within Elliott triangles. So the +1/2 standard deviation is at 119.29, and the +1's at 122. We don't think the Russell is going to get above 1190 here. Okay, so the equivalent over here in the IWM is about $118 in the IWM. That's not even at a +1/2 standard deviation. We don't need to go out too far based on our analysis of the Russell. We definitely don't need to sell a +1 standard deviation all the way up here at 122. I mean, that's way out of the pattern. This guy should not get above the 118 here in the Russell, and definitely shouldn't get above 120. So what I'm interested in doing is the first half of this, selling a 1/2 standard deviation around the 119 to 119.5. All right, so let's just pull that one out, and we're interested in the 119. We'll call it 50, see what strikes are available. Okay, on the downside. Now, the minus 1/2 standard deviation is at 113.52, and I'm looking over here at the left scale, and that's right about here. Okay, a little bit above the ideal stopping point, which is 1125 in the underlying, or 112.40, 112.50 over here in the IWM. Okay, so that's interesting. So the minus 1 standard deviation is all the way down here at 110. I don't think the market is going to get down to 110 before October expiration. So what I'm looking to do is do the half standard deviations. Okay, now you might say to yourself, Todd, why? Your support is down here at 1240 in the IWM. Okay, the half standard deviation is at 113.52. Remember, this is for October. So what we'd envision to happen is for this to go down against us into early October, then find support and move higher into October expiration as we rally up in wave 5 towards the end of the year. Okay, so we're expecting this to go down. We'll make money on the short calls. The short puts will be tested. We might have to adjust a little bit, but then once the market finds support, then our full iron condor will expire worthless, and we should be in pretty good shape on this trade. So let's get into the platform. Again, the trade we're looking to do is we want to do the 119 halves, 113. So let's price this out. Okay. So in October, we want to sell the 119 calls. Sell, we're going to do an iron condor. We're going to sell the 119s, 120s, that's fine. And then on the downside, we're going to do the 113s, the puts. Oh, they have halves there, that's cool. Oh, no, they don't. Sell the 113s, and we'll do the 112s. We'll do dollar wide spread on either side. So altogether, we're going to sell 119s. We'll sell the AUK 119 calls, buy the AUK 120 calls. We'll sell the AUK 113 puts, buy the AUK 112 puts. Total credit should be about 59 cents. And that's the trade we're going to be looking to do tomorrow. All right, guys, so that's combining standard deviations and half standard deviations with Elliott Wave, coming up with a game plan to take advantage of slightly elevated volatility right here in the last couple days to play a range-bound market. All right, guys, a lot there, but it's pretty fun stuff. So we'll be looking to put that trade on with our clients tomorrow. If you haven't taken a trial to the company, tradinganalysis.com, just come on over. You can just simply go to tradinganalysis.com, join today. You can take a $7 trial. If you're not quite ready, just go ahead and give us a like on this video, give us a subscribe, and you'll see videos like this every day. All right, guys, good luck trading. Hope that helps. Hope that made sense. I know there's a lot there. And see you next one. See you on the next video update. Bye.